Hello and welcome to Let's Talk Business. I'm Vedant Agarwal. Let's get you a wrap of all the business news of the day. Well, starting with markets. Markets advanced for the second consecutive day. Sensex closed above 65,000 level and Nifty rose beyond the 19,500 mark. Metals led along with advances in PSU, banks, IT, realty and media sectors as well. Alex Matthew with a wrap of all the market action.
It's a good start to the trading week for the Indian equity markets. We gained ground and built on Friday's gains. The Nifty 50 ending with gains of about 0.5% or thereabouts and reclaiming the 19,500 mark. If anything, the broader markets outperformed yet again with both the mid-cap as well as the small-cap indices gaining close to 1% each. Now, the IT pack as well as the metals were in focus today. Both of those packs gaining over 2%. But you also had quite a few of the stocks that are allied with the railway space that were at the center of action in trade today. Now, a couple of themes playing out. One, of course, is the expectation that China will step in to bolster its real estate sector, and that has tailwinds for the metal pack as a whole. You also have the expectation that the US economy might just have escaped a hard landing, and that bodes well for the IT pack. So that is kind of an explanation as to why those two sets of stocks were gaining ground today. The banking and financial names underperformed, but a sub-component of that, the PSU banking pack, was up quite substantially today. The top gainers then, you have Coal India, Wipro, HCL Tech, Ultratech Cement and Tata Steel that were the top 5 gainers. We'll delve into a few more details there, but among the top losers, you had the likes of Mahindra and Mahindra, Axis Bank, ITC, Nestle, Bajaj Auto, as well as Asian Paints. Now, Tata Steel was one of the top gainers today. It advanced because it's in last mile talks with the UK government for funding of about £500 million for decarbonisation efforts there. Coal India gained ground, was the top performer on the Nifty 50 on account of an improvement in output, which saw output in August grow as much as 13% year on year. IDBI Bank from the broader markets was one of the stocks of the day, gained quite substantially because the government's bid to sell stake is gaining ground. Real stocks, as I mentioned, quite a few of them seeing bunch trades, and of course recent orders also boding well for the sector. IRFC, for example, from that pack gaining about 20% in trade as about 0.5% of stake exchanged hands. All told, it's a strong start to the trading week. We'll have to see how far this goes.
Well, moving now to sectors, Vinay Jaising of JM Financial Services explains the rationale behind why one should buy PSU stocks and what are the stocks to look at in this sector. Listen in.
There are a lot of railway companies and defense companies which, yes, have moved from 15 to 20 time multiples to straight away 25 to 30 time multiples. But if you look at their last quarterly result, you see them doubling their profits, some of them especially in railways, and you're seeing analysts increase numbers by 30 to 40% in the future. So yes, they look at 25 to 30 times F25 numbers, but my bet is analysts will keep on increasing numbers. Interestingly, geopolitical risk is here to stay, irrespective of the political condition in the country. Next 12 months, the biggest risk obviously we have is politics. But keeping that aside, you will not see a reduction in the budget in defense. And defense is one area where, though the stocks have done really well, where we would be focusing on, all the PSU companies in my eyes look relatively very good in this space. Similarly, as the rail budget has increased, and I said, multi-fold time, there's a problem of supply of products for these people. Their capacities are enhancing. That's a beautiful problem to be in, and none of them are largely over-levered, which means most of them, are more or less at under one time under one time net debt to EBITDA, which makes them also look attractive on a ROCE basis. So I would be betting on railways. I would be betting on capital good sector. These are two spaces where I would bet on in the PSU space along with defense.
And well, the big question on investors' mind, will September bring cheer for them on the Dalal Street? Well, can Nifty scale mount 20K this month? Well, Rahul Sharma of JM Financial is bullish on why Nifty scaling a new high in September. Well, he expects Nifty to add 1,000 points this month. Listen in as he explains the reasons behind the up move he expects.
what I see is once we cross, for this week, 19,600 seems like a very high possibility. Once we cross 19,600, I think the next stop will be directly at 20,000 and above that 20,400. So these are the two hurdles that we have to keep in mind, playing into the month of September. As far as supports are concerned, I think 19,230 was the final blow below which Nifty failed to sustain. So that, acts as a base going into the September series. So one can have a stop loss placed at 19,230 on the closing basis. And as far as the current setup is concerned, it's not a buy on dip market. It's a market where we have to add more on confirmation of resistance breakouts. So look to add as the market scales up, because we have to not forget that this is still a bull market, and the more thrust is generated on the upside, the more upside it should generate in terms of points for the Nifty. So good possibility, good probability that we head towards the 20,400 mark, which is like a 1,000-point rally, incremental rally from where we closed on Friday.
And ahead of the festive season, Indian automakers posted an increase in passenger and commercial vehicle sales in August. The auto industry witnessed a robust growth in sales, with Maruti Suzuki recording its highest ever monthly sales volume, while Eicher Motors' commercial vehicle arms sales also registered a sharp rise. BQ Prime spoke to the managements of both the companies. Listen in.
Generally, yes, you are right. You would see some sort of an uptick in the festive season. For these smaller cars, definitely, I think so. But, if you look at it in the broader perspective, we have been seeing a decline in the hatch segment, and you're largely because of the affordability factor. This segment, consumers are very price sensitive. There is a high elasticity of demand, and we have seen prices going up in this segment due to various reasons, including regulatory stringency, including road tax, registration tax going up, or even prices going up in response to the higher feature level or the higher commodity prices. So these are the reasons why it has come down. And yes, you are very right. In August, you saw the SUV sales almost touching 49%. And the B segment sale, which in the utility vehicle segment, has gone up to almost 57%.
Festive season, we are expecting good demand because there is a lot of buying happening around these festivals. And there are good reasons for replacements. We are going to get more and more replacement demand. And apart from replacement demand, there is also the new addition to the fleets, because the economy is growing and there are a lot of investments happening in infrastructure. So therefore, based on all those positive factors, we are expecting good demand. And also, it will get the further boost because of the festive season. So as it is, these are the better months. Like now, monsoon is over now, and monsoon, there is a sluggish demand in the CV industry. But now, I think the good period starts now.
In other news, India's government-owned oil marketing firms could be heading for a weaker second quarter. This as Brent crude prices rise and fuel retail prices remain steady. Stocks of major public sector unit oil giants have declined in the last 2 months. So what do analysts expect, and what will be the impact of upcoming elections on the OMCs? Mehika Barve with the details.
Let's talk about why top state-owned oil marketing companies have been under pressure this month. Indian Oil, Hindustan Petroleum and Bharat Petroleum have cumulatively dropped more than 18% in 1 month. This is due to weak expectations for quarter 2, contracting marketing margins amid rising crude prices while retail prices remain fixed could have an impact on OMC EBITDA and net profit coming quarter. OMCs have held steady petrol and diesel prices since May 22, 2022, and a 3.85% crude oil drop in Q1 led to supernormal marketing margins, and the companies were able to recoup their FY23 losses. However, market conditions have now shifted. Brent crude oil prices have surged by 17.86% since July 1 and now stand at $88.62 per barrel. Moreover, FY 2024, an election year, could see government-led cuts in fuel prices, creating difficulties for OMCs to transfer costs to consumers. Now, where do the margins stand? As per Prabhudas Leela, the gross marketing margins on petrol have shrunk 45% in August to Rs 5.5 per litre from Rs 10 in quarter 1. whereas diesel margins have entered negative territory in August 2023 versus rupees 12.7 per litre in Q1. However, OMCs may find some support in the rising crack spreads, which refer to the price difference between a barrel of crude oil and the refined petroleum products. Petrol and diesel crack spreads have rose 9% and 2.15 times per barrel in August compared to Q1. These expansions would have a positive impact on the firm's refining segment, thus contributing to profit margins to a certain extent.
Well, that's all that we have on Let's Talk Business. There's more on the inside.